upside calls, and we tell you they're still not performance you should be chasing. Your positioning, your unit of account is not your fiat of your nation that you are residing in. Your unit of account is 100% a gold ounce, and it is international, and it doesn't scream. Again, I'll just bring that chart back up to make sure we're talking about the same thing. We're at a triggering event break of a level here on this. This is a reversal pattern that had incredible volatility. There was an effort to fight back. That's that wick. It then charged back up, and it's been wicked back down. Almost, not quite. That's a heck of a sell-off. But you were absolutely smashing it. You were smashing it. How many green candles in a row? 2, 3, 4, 5, 6, 7, 8. You had 9 months in a row, getting ever more bigger and faster. It was just throwing profits at us on our leveraged trades. In a monthly period where the current month has broken now and staying below the neckline of relative valuation. So 4.58 ounces is where you're at. And the neckline is 4.65. You can see that blue number.
Hey everyone, my name is Anthony Fatsis and welcome to another episode of the What the Finance podcast. On this episode, I have the pleasure of welcoming back very popular guest, Francis Hunt. So Francis is a trader, technical analyst, teacher, and originator of the Hunt Volatility Funnel Method. So Francis, thanks so much for coming back on the podcast.
Delighted to be back with you, Anthony.
Yeah, looking forward to the conversation. A lot has definitely happened. We spoke 6 months ago, and yeah, precious metals absolutely booming, more state control trying to come in line. But yeah, very much like to start broad. What are you currently seeing in the economy and markets?
Wow. The debasement of the dollar is real. It's having a little mini flurry right now, but the debasement of the dollar is very real. The debasement of fiat and other assets is very real. We shared on X yesterday our call that we made on the Nikkei when it was at about 22,000. It was a neckline of an inverted head and shoulders. And we said, not only is it going to run the previous high, that was the 39,000 of the 80s boom. And you've got to remember the Nikkei has been a busted flush for multi-decades, since 89. It just went down, down, sideways, down, 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 sideways. It eventually regained a little bit to get to the 22,000 mark, which is still, and that was in the 2020s, which is still, since 89, 31 years behind. And we said, okay, now it's going to run like you've never seen it run before to 74,000. And it's in the mid 50,000s now. So it's more than double the neckline that we had for it. And for me, it's a bit of a, in fact, I've got it right here. So if I just share it, it's, sometimes saying and showing is two different things. So if I just share screen, you'll get to appreciate it. We'll do the entire screen. What you'll spot about this is, there it is. You can see in 2020, this is where we were saying there's going to be a major breakout. This is log scaled, by the way. So please understand this distance is huge. That is, around the 22,000s, and that is 74. That's literally three times, more than 3 times of it. And in and around the 2020, 2021 period, we were saying this is going to break and it's going to do this. And it's doing exactly that. And there's a reason, and this is a microcosm of what's happening on NASDAQ and other markets in other nations, countries across the world. It appears like you're having an amazing economy because the markets are going up. But what's also been happening at the same time we made those predictions, and this was just following our call of the turn in the debt markets in 2020, we also rolled into 21 and said the Japanese interest rates on the midterm, long-term yields were all going to go extremely high. At the time, they were around 0.1s, 0.2s, and 0.4s. All well below 0.5% on the Japanese bonds and interest rates. And we said these are going to go to 4s. And that sounded outrageous because, again, like the Nikkei, there was the 1989 high on the Nikkei. You'd had these multi-decades of just below 1, below 0.5% in interest rates as well, this entire period. We are saying The turn in the US debt market is shining the light on all forms of debt. Japan also has an immense amount of issued debt, and the rates are going to start going up, which has been one of our primary theses. Rates higher than people expect, higher, faster, for longer, pullback shorter, lower and very minor, and then reasserting higher. And Japanese inflation officially, I've got to come back to the big lie of America and its inflation, but Japanese inflation officially is now higher than American. And you've got its long bonds rates going up and up and up, and all of this. And at the same time, you've got the Nikkei climbing. And this is all on a debasing yen. So the yen is losing value. The rates are climbing. So many people think, rates up, the currency goes up. But the difference is it's not a healthy rates up. The economy is strong. We're going to take some of the punch bowl away. Everyone's partying too hard, too much liquidity and all of that. It is debt collapsing. And fiat collapsing, because people need to understand fiat and debt are the same thing. The debt is just fiat promised at a later point, for which a rental agreement is associated, the usury extraction of interest rates. So you're watching fiat debt, same thing, just one is got a time frame to it, debasing chronically. This is why interest rates are going up. And it's also why the stock market is going up.
Francis destroys the mainstream narrative with one insight. When government issues bonds, debt, they're printing future fiat now. The interest is usury extraction in a Ponzi where debt serviced by more debt. Why are rates and stocks both rising? Both nominals inflating as currency debases faster than either. It's collapse disguised as growth. Japanese example proves it. Rates 0.1% to 4%, Nikkei 22K to 56K, yen falling, all simultaneously possible only if denominator currency dying.
The stock market is going up and is going to make 74,000 as we're illustrating here. And I really do want to show you this out of log scale because you'll see how huge this is. A move that we've already predicted, and that 56,000 where the Nikkei is to 74,000 is still a long, long way, but it looks very small because this is a log scale. That is a percentage based. But the key real story behind this is when you take that same Nikkei since the 80s and you divide it by gold. I've got just 2,000 here from 2006. But what you can quite clearly see is that the Nikkei actually isn't performing amazingly in gold ounces. And when I say gold by yen, because we're talking about Japan now. So the Japanese primary index, gold in Japanese yen, because the Nikkei is obviously in Japanese yen, divided out. And what's actually happening is you're getting a rebasing downwards of value, a chronic rebasement and down in value. Yes, you had a little bit of overperformance here during this era from about 2012. That was when the West was doing QE and Japan relatively less so. They were the original QE. Then the West started doing it. So they were debasing chronically when they were doing QE. And then we started, of course, 2011, 12, you remember all of that from the lows of 09. They got a bit of a run and now they've been debasing again. So you're actually looking at a microcosm of the whole economic system here when you look at this. What is actually happening is that you are facing a situation, and let's just go and put that Nikkei back on for you in the live charts, not just screenshots. You're watching a situation where on the one hand, it looks like a runaway market. There's the live chart. Since here we are just runaway, and here is it. This was how big this call was, by the way, the scale I was showing you. So when I delog that, you can see the 70 isn't even on the page now. I need to actually drag it down. That's how much further we still have to go. But that was a huge, huge call. We said it's going to happen unerringly quickly. But it's happening unerringly quickly in unerringly fast diminishing yen.
Nikkei is Francis's proof, called 22K to 74K, 3x nominals, huge. Media, Japan back. Reality, divide by gold in yen equals steady decline. Rates up 0.1 to 4%, stocks up 22K to 56K, inflation up, yen down, all four only possible if currency dying. This is global pattern. Nominal bull market equals real gold ounce bear market.
The fiat debt debasement is the only thing that matters in terms of your understanding of what's going on. And I've gone long form on you, but your question was, what's on my mind? What do you think people need to know? And here's the point. It doesn't actually matter. You think this is a Japanese phenomenon. It 100% isn't. This is a fiat debt debasement environment. And here, just so that you can see where these chart comes from, let me just go and get that divided so you can see it live, because I showed you screenshots. XAU, JPY. So we are taking the same Nikkei in yen, and we're dividing it by gold in yen. So we're canceling out the yen, and we're seeing the Nikkei divided by gold. And if you have a look at that, and you have a look at the history. Now I want to just get, not the Pepperstone, that's too short. It always substitutes that one in. I want to get the FXEM. There's your history. There's your history. I'm wondering if we can find one that just gives us even more than that. I don't know why we have a shortage of yen history. Let's just go Saxo Trader, because I want you to see that all of these are actually rebasing down. They're rebasing badly down. Let's see if I'm trying to find one that actually has a bit of a better history. Not quite sure why we're getting so little history, but the point is quite clear. It's rebasing down, and it doesn't change, by the way, a key event. Let's just do the exact same now for the NASDAQ. Everybody, tech. NASDAQ. Okay, let's do the NASDAQ. Now that's in America, so we do USD, and it's dollar-based. And I want to show you that the song remains the same. It's a famous Led Zeppelin tune. The song remains the same. And I want to show you this so that you can see this is, the world as it stands right now. There was a time, I'm going back to log scale, where tech certainly outperformed the gold market. And in fact, let's go 3 months, get a bit more of that history a little bit more tightly. You can see when it happened. During this period here in the run-up to the .com was a single-minded period. We had peak gold at 1980. You should not have been in gold. You should have been ideally in tech stocks, and you would have chronically outperformed. There it is. That's your moment. Since then, you had a large deflation. You had an echo bounce. So you could have argued there might have been a decent period between the subprime lows till around 2021. So 2021 from about 2012. You could have had an echo bounce but you never made the previous highs. And now, if we go to the monthly time frame, this is considered the best tech-based stock market performer, of probably all the nations in the world, the United States. And here's where you are. You are in a real problem. I'm going to just make that line a little fainter. You can see we've got a neckline here. You've got a head and shoulder against gold. This is in a major head and shoulder, and it's triggering. So we're talking in a monthly period where the current month has broken now and staying below the neckline of relative valuation. So 4.58 ounces is where you're at, and the neckline is 4.65. You can see that blue number. So you need 4.65 ounces of gold to buy a basket of weighting of tech stocks. And this is in a head and shoulder collapse to the downside. And if I bring that target into play, you could end up, clean my face a little bit there, at 0.32. So you tell me, what's the better asset to be holding?
Smoking gun for stocks bleeding. NASDAQ divided by gold shows head and shoulders on monthly chart. Neckline 4.65 aughts, current 4.58 equals belows, confirmed break equals triggered. Target 0.32 equals 93% decline from current in real purchasing power terms. Even if NASDAQ holds nominally, it's collapsing in gold ounces. We're at month one of decades-long reversal where tech underperforms gold massively.
The alleged best asset that everybody has been holding because of the dot-com boom and the echo bounce of 2012 to 2021, late 2021, around about there. Since then, we are early doors in the rebasement downwards of all assets, particularly tech stocks, but of all assets, housing, retail housing in gold ounces. Everything in gold ounces is losing. Even silver right now, but it was overperforming until it slapped in the face. Miners will occasionally outperform and have had a spell of outperformance. It's very hard to beat the gold ounce. And my entire thesis is, and this, if everybody, and I'm going to finish now because I know I've gone really long form and you've just had that one question, but this truly is the entire thesis of understanding everything, how the world is working. Your global nation states, wherever you are living, are actively in a debt and fiat debasement cycle, whereby everything that was inflated in the everything assets bubble is currently being deflated, and you are not noticing because of being a nominal normie. The value of your house is still the same in dollars, euros, pounds. You think your stock market portfolio actually went up a little bit. Gold went up 70% is all you need to know. Everything else went down by whatever they went up, less than 70%. That's your NASDAQ, that's your everything. It doesn't matter whether I'm talking Japan's Nikkei or right over here. We've made ridiculous upside calls, and we tell you they're still not performance you should be chasing. Your positioning, your unit of account is not your fiat of your nation that you are residing in.
Nominal normie, brilliant framing. House 500K to 550K, think plus 10% richer, but gold $1,800 to $5,000 plus 178% equals house went 278 odds to 110 odds, 60% poorer. Nominal normie C plus 10%, miss 9 to 60% reality. Gold up 70% is ruler. Anything less, you lost. The paradigm shift, stop measuring dollars debasing, start measuring ounces, stable real value.
Your unit of account is 100% a gold ounce, and it is international, and it doesn't scream. There's no board, there's no committee that's going to push it. Only people like me, messianic people who are talking for free and really passionate about trying to help people in the financial world are going to say this. You're not going to hear Epstein say it. You're not going to hear, and believe you me, he's alive somewhere. You're not going to hear Klaus Schwab say it. You're not going to hear your president say it. They are running a shell game against you. You are the marks. It is an adversarial system. They need you to stay put and not understand what is going on so that they can continue to accelerate that which they are doing. You are in a financial war. If you didn't read any of the Epstein recent revelations, many of the things we have said have now been further confirmed. We can drill down on that, but you are in a spiritual war. You are being attack vectored on every level. Now, the financial part of your preservation, which is not the everything part, but it's an important part, means you need to understand this one key point that I am making. Your unit of account is a gold ounce. That is it. Everything else is deflating currency, everything, and devaluing assets that were hyper overvalued during a debt binge spree that turned in 2020, for which we were the first to call before Tudor Jones, before Druckenmiller started talking their book in 2024. And it's not out of ego I say that. I'm just saying that was in 2020 is the point that it turned. The proliferation and theft that they perpetuated during the COVID was the final theft. There is no more market for bond instruments anymore. And it has to devalue, and they are working all sorts of schemes. Cayman Islands owns 37% of the long end of US debt issuance.
Francis exposes mechanism. 2020 debt turn equals inflection. Pre-natural buyers, China, Japan, pensions. Post-exited. Only manipulation remains. Cayman owning 37% long end. How can $7 GDP own $3 to $4 debt? Shell game. Goldman hedge funds doing basis trades with unlimited Fed funding creating artificial demand. Even manipulation failing. Rates rising 0.5% to 4.5 plus. When basis trades unwind, game over.
Leveraged Cayman Islands with a 7 billion turnover. Right there under the belly of the beast, stuffed with Goldman Sachs hedge fund managers and other dark statists that are maintaining the Ponzi scheme, that are being given unheralded 24-hour finance by the bulge brackets. Try get that funding deal that the basis trade guys in the Cayman Islands do. Okay. I'll tell you something else. Operation Twist, that was really interesting. That was the end, the long end being reverted. There was QE 1, 2, 3. You'll remember that. Then there was one that was called Twist under Bernanke. And the very interesting part about that is the state bought the long end and sold the shorter end. What happened is China got out of their 20 years, their 30 years, and their 10 years debts into 5-year debts and 3 years and 2 years, so that they could let that expire and not roll it on. They stopped buying. That was already during QE, the previous one. So they have been static and their bond portfolio is devaluing. And at the same time, they've become prodigious buyers of gold. The wealth is moving from where we currently have very high living standards, Westerners, European nations typically. So we're talking Europe, Commonwealth, America, and United Kingdom.
Francis reveals wealth transfer. Operation Twist, 2011 to 2012. China used to exit long holdings. Swap 10 to 30 year into 2 to 5 year to let expire, not roll equals stealth exit. Holdings flat 1.3 T to $800 equals in $500. While exiting treasuries bought 1,000 plus tons gold officially, 3,000 to 5,000 plus actual. They're swapping. Debt, paper devaluing, gold, real appreciating. Sold high, 2020, bought low, $1,200 to $800, now $5,000 plus equals nailed trade. You are the marks equals Western fiat holders being fleeced. Hegemon falls from highest ladder, Triffin's dilemma, reserve currency exports, most papals, most debasement, biggest fall.
And you are the marks. Most of you watching that will be in one of those nations, and you are the marks. You are going to be brought down in living standards, most by the fiat, and the hegemon falls from the highest ladder. Anyway, I think I've said more than enough. There's so much for you to unpack. This is the key concept people need to understand.
Yeah, definitely a lot to unpack, and thanks for showing us how it looks as well. What do you know, if I looked at that chart there, it does look like it's coming to sort of a bit of a support, especially in NASDAQ gold. And it looks like if you look at the precious metals charts, they do look extremely toppy. Do you see that as a potential shorter term, next couple of years reverse before we get that sort of final push up, or how are you actually looking at the market?
No, I don't see it anything like how you described, actually. I see you're at a triggering event. Again, I'll just bring that chart back up to make sure we're talking about the same thing. We're at a triggering event break of a level here on this. This is a reversal pattern that had incredible volatility. There was an effort to fight back. That's that wick. It then charged back up and it's been wicked back down. So despite recent setbacks for gold and more particularly silver, for example, you are at a breaking point, and that's where it gets disorderly quick normally. You can, of course, get a return move. I would argue you might have already had that on a smaller time frame. Don't forget, I'm showing you this on a monthly time frame. We can go and have a look at it. So to me, it's about to get more interesting for the debasement of tech stocks. If I go to a weekly time frame, you can see this. You have a kind of a hammer here, and you then go rallying all sharply back up and attempt to revalue, and then bang, straight back down. This is typical skittishness at a key level of significance, which previously had support, but couldn't make a new high, made a lower high, and is now rolling over and running this low, and there's a battle royal happening, and one side wins, and then you spill. And, for me, that is going down. That is going down. So we're about to see a resumption of gold strength. You had a little bit of sketchy numbers. So now, to answer your question, I have to bring other things into account. So you had a non-farm payrolls number that came in, not on Friday, because government shut down and all of this. Don't forget, they're still hardly doing stats. They're doing this whole fake light. Oh, we don't really have the people. Oh, we've cut how much we're spending. This is all going to be cover for the lies they're generating right now. We were on the beginning 3 years ago when you had, 21 or was it 22 with Yellen and Biden? When you hit a recession, I said that's a recession. Because it's criteria. The criteria were met. They said, no, you can't have a recession and have such a red hot labor market, and all of this stuff. They were hiring DEI employees. They were doing the whole, government was doing a massive hire, and companies that were doing contracting services to government were the only areas of growth. It was 56% of all employment increases. The rest of the society is moribund in the US. And he's struggling. And here you had government that was doing it. We said it's all a lie. They've re-rated 3, 4, 5 times monthlies, quarterlies, and annual labor stats. It's a complete lie. The whole propaganda of the state stats is to perpetuate the deception of the corrective realm that you are in, ergo your gold ounces valuation. That is the truth. So it is not Bureau of Labor stats for information. It is for active acts of deception to keep you in the mindset that everything is fine, carry on, keep calm and carry on. And I'm saying absolutely not. And the CPI, they had this benign CPI number, 2.5 and core at about 2.4 even. You're talking about a country in the United States that's currency lost 12% plus to the euro, one of its largest deficit trade bloc nations that it ran a record deficit with. That means you're buying more of their stuff than they are buying of yours. And China, you had a 6% deval to the Chinese yuan. So last year, the dollar was losing, never mind the fact that it was down 42% against the ruble, 16% against the Hungarian florins, a swathe of currencies, an absolute swathe of currencies, which proves our point also that the hegemon falls from the highest ladder. It's going to have the greatest loss in value, buying value of all. Why Triffin's dilemma? What is Triffin's dilemma? The aspect that when you're the hegemon, you throw out way more paper in lieu of excess goods that you are buying.
Francis exposes CPI Lee, dollar down 12% to euro, 6% to yuan, 42% to ruble, 16% to foreign. How can you import bulk goods from currencies rising double digits and claim 2.4% inflation? Answer, Lee. Shadow stats, Regan methodology shows near double-digit real inflation. Car example, 20% more expensive but 15% more expensive for 20% better tech equals net deflation. Status statistics masking Ponzi unraveling,